dear customers and friends. We are delighted to personally welcome every one of you and to thank you for attending our customer appreciation event. It is a true honor for us to host you tonight. Following our tradition, I would like to introduce some of our key global as well as North American managers present tonight. In doing so, we hope to give you a good idea of the personalities and the wide range of geographical coverage and specific capabilities that UTC offers to our clients across many business sectors and industries.
Our presentation tonight on the financial situation of carriers, we were looking for a speaker and on specialized carriers, and we're very proud that tonight we actually have on our own team former President of SAF Marine, Ian Barclay, that will come up and give that because of the Hanjin bankruptcy. That's a hot topic in the press. And we also have our guest tonight, Royal Vagenborg.
The financial stress that the container shipping industry finds itself in. At the end of my talk, I'm going to hand it over to Royal Vagenborg, who will talk about their specialist section in the carrier market. And between the two of us, hopefully we can paint a picture of how we see the way ahead. So without any further ado, let's have a look at the container shipping industry. We'd like to start by giving a very broad macro picture of what this container industry is about. 60% of global trade by volume currently moves on container ships. There are some 6,000 odd vessels that are deployed to carry containers around the world, of which over 5,000 are fully cellular. Current capacity is in the region of 21 million TEUs. A TEU, 20-foot equivalent unit, is the measure by which container lines justify their volumes. Last year, capacity increased by 3.7%. And currently, the order books have 183 new ships that will roll off the production lines in the next 18 months, adding a further 2 million TEUs of capacity. Now, the amazing thing about these new ships that are coming off the yards is that they are absolutely huge. Average size in the region of 12,000 TEUs. Absolutely inconceivable size vessels if we go back as little as 5 or 6 years ago. Container ships make on average 9,000 port calls a week around the world, and global trade has grown annually by 7% years 2005 to 2011. So I think we would actually look at this picture and say, this is a pretty healthy industry. Of course, we know better. Container growth has slowed to 2% in 2015, and that is forecast to continue at about that level for the next 3 years. Carriers have had a capacity well in excess of demand. There's been a huge increase in vessel sizes, as we alluded to earlier on, and I'd like to just spend a quick few minutes on looking at that. In the early 70s, when containerization first started, average vessel size was around 1,700 TEUs. And that bumped along for at least the next 20 years, going up fairly slowly until by 2005 we had vessel sizes in the range of 5,000 TEUs. Since 2005 to the current day, there's been an explosion of vessel sizes. First 8,000 TEUs, then 12,000 TEUs and 14,000 TEUs. And now we have some monsters in excess of 18,000 TEUs that are coming off the yards and plying the trades of the world. These are massive, massive ships. Supply, of course, is now well in excess of demand. We've had the perfect storm, decreasing overall growth in demand globally, and then, of course, this huge increase in the number of vessels and the size of vessels that are being deployed. The net result? 20% of vessels are currently lying idle. Global shipping is forecast to lose nearly $15 billion in 2016. Just have to look at some of the major carriers. Maersk Line in quarter 2 lost $212 million. COSCO, major shipping company, lost $500 million in quarter 2. Banks supporting the shipping lines and the charterers who are buying ships to feed this growing demand, they are now beginning to pull back and are seriously questioning why they have such a heavy investment in the industry. In fact, daily, if you look at the various different media reports, there's a new report of a bank in trouble with its toxic shipping loans. Royal Bank of Scotland having to write off $3 million for its Turkish shipping loans. German banks currently owed something in the region of $100 billion have serious concerns about their ability to get that debt back. And then, of course, Maersk Line tell us that in 2015, average rates dropped by 24%. And if we needed any further proof of just how bad this industry is at the moment, we had the bankruptcy of Hanjin Shipping Line a few weeks ago. Now, Hanjin Shipping Line just wasn't a fly-by-night. It was a serious player in this market. They, at the time of their departure, were the 7th largest global carrier in the world. There was something like 540,000 containers that were impacted by their bankruptcy, $14 billion of revenue tied up. And a lot of those containers took months and months and months before the shipper could get hold of them. Now, of course, the question our shippers ask, well, why did you have any containers booked on Hanjin Shipping Line? Surely you knew that they were in bad shape. Yep, we did know they were in bad shape. But if we look at a picture of all the shipping lines in Q1 in 2016, of this sample that we looked at, and again remember, not all shipping lines declare their results, of those that do, a mere 2 of them were profitable in Q1, Maersk Line and Wan Hai Line. And if you look at how profitable, that was absolutely minuscule. And you'll remember from a previous slide that Maersk then slipped into a negative result for Q2. But all of the other shipping lines, and some of them quite substantial, were largely in the red. Hanjin Shipping Line, in the greater scheme of things, wasn't actually that bad off. There were a good number of other major shipping lines that were in far better shape than them. So what's happening? Is container shipping about to implode? I think to answer that question, we've basically got to go back into history. Shipping is probably the 2nd oldest profession in the world. Those of us who work on it sometimes think it's the oldest profession in the world, but it's been around a long, long time, and it's been through cycles and changes throughout that period. I can remember when I first joined the industry, and we had a town hall meeting which our chairman addressed, and he said to us, this year's been okay, but next year is going to be tougher. We're going to have to work harder and smarter and more efficiently. And he was right. Every year since then, it's going to be tougher in the next year. And you know what? They were right. It did get tougher and tougher. The other thing that was a constant in this period, that when we spoke to our customers, our shipper base, they continually told us, you're just too damn expensive. Your rates are too high. At the time, we didn't think they were. After all, we're working really, really hard and as efficiently as we thought we could. But looking back at it, there was massive inefficiency in the industry. That has long since been drained out of it. Those shipping lines that are around today are ultra efficient. They know exactly what's going on with their businesses. When I came into the business, the shipping line that I was part of was in a consortium of 11 major shipping companies. These shipping companies were brand names. They were known internationally. They were in many cases the national shipping lines of the countries in which they were involved. For example, Compagnie Maritime Belge, the Belgian national shipping line. Nederland, the Dutch national shipping line. Huge, huge companies, some of them over 100 years old. Terribly, terribly successful. Within 10 years, only 5 of those original 11 lines remained under the same ownership. And if we look at it 20 years since then, 20 years on, only 1 of those lines retains its original ownership and operates as it did when I first joined. Deutsche Africa Linen, the German company. Every single other line has been taken over by someone else. Now they may still operate under their own original name, but their ownership has changed. So shipping line failure, we would argue, is absolutely not new. So what lies ahead? Well, let's take an example of an average shipping movement. Movement of a container from Shanghai to Carson in California. By far and away, the longest portion of that journey is the soy voyage from Shanghai to Long Beach, some 5,700 nautical miles, and it comes off the vessel in Long Beach and it trucks through to Carson, which is 10 miles from the port. If we look at what it would have cost you in 2006 in week 38 to move that container, you would have been paying on average $2,800. 10 years later, you'd be paying $2,400. So over a 10-year period, there's been some significant reduction in the cost of moving that container. But then you've got to really dig into those numbers to see where the hurt has come. If we look at what the breakdown of that cost was in 2006. The port was averaging about $250 for the cost of getting the container off the vessel through the terminal and to the gate. The trucking company that picked it up at the gate and took it to Carson was getting about $375. And the shipping line was realizing just over $2,000 for its efforts to move it from Shanghai. 10 years later, well, the ports are now getting on average something in the region of $300 a container. Nice little increase over that period, and if you consider the efficiency that they've got, that's really good money. They're in a pretty healthy situation. If you look at the trucker, on paper, it looks as if they've had a nice increase, going up to $610. But what you've actually got to do for the truckers is look into that number, because there's been so much regulation that's been thrown at the truckers that there's considerable extra costs that they're now realizing to operate a service, that their actual increase over the period has been minuscule. And that's one of the reasons we have a bit of a trucking crisis in the US, in that there's a shortage of truckers because people are simply not willing to work for the costs or the revenues that they realize.
Wagenborg was founded in 1898, 100% family owned, became royal in 1998. And I'll explain you a little what royal means. If your company is over 100 years old, you're financially stable, you have not done any criminal things, which could happen, and you have over 100 staff members, you can apply to the Queen, or at the moment it's the King we have, and you can apply to be royal, which we got in 1998. To give you an example, KLM, the K stands for Royal. With the merger with Air France, it might be a danger that KLM will lose the K, because it's not a fully owned Dutch company anymore. And so that is what can happen. The other way, sorry. We have 180 vessels connecting worlds. We have supply vessels, shallow draft icebreakers, pontoons. We have drifting millimeters with SPMTs, giving shelter, and we are building bridges. Onshore, we have our trucking, special trucking. Offshore, we have a new type of vessel, a walk-to-work vessel. At sea, we have, as I said, 180 vessels varying from 2,000 to 23,000 tons.
We'll just explain you a little bit about how we see the financial stability. It will not be a bleak picture that has been already discussed by Ian. I think we're all aware of how the industry stands for. But what I want to address is just how we as Wagenborg see the future and how we think that we can face the challenges that have been clearly sketched by Ian. For us as a company, we are financially stable, positive EBITDAs, interest being paid, shareholder interest. We're not focusing on the next generation. We're focusing on the next. We're focusing on the next generation, not on the next quarter. We're a privately owned company, 100% family company, and that helps. Still developing our fleet. But how do we do that? Our focus is we need to keep investing. Don't stand still. Keep investing in relations, like here today, our relationship with partnerships with UTC. But also invest in your people. I think the picture was sketched earlier today, also for UTC. Very important to respect your people, also within Wagenborg. That is an important focus. And invest in the future. Keep on moving. Don't stand still. For us, technology innovation is important to support the company. Scrubber technologies, you see the regulations developing, you need to move, you need to become more environmental friendly, and we keep on doing that. Walk-to-work technologies, my colleague already told a little bit about it, there will be some more pictures. And move out of your comfort zone. We have just been one of the first commercial carriers taking the Northwest Passage, so coming from China, going to Canada, not via the Panama Canal, but going up north. Can only be done a few months during the year, but still it is one, it saves a lot of time.
The main purpose of our evening tonight is you, our customers. We want to thank you all for attending. Those who are not customers yet, I think you do yourself a disfavor by not becoming a customer.